Millions of people. Welcome, everybody, to the Chinchilla Pickin' Podcast. It is December the 16th, 2022 at 8:20 p.m. As always, we hope to be entertaining, educational, and uplifting because we want everyone to make money. My name is David Underwood, and I am here with Brandon Beaver. Brandon, how are you, man?
I'm doing all right. How about you?
I am doing well. I'm doing very well. I'm looking forward to this podcast we got going on. It was a good night. Enjoying
Santa
myself.
rally?
It's Christmas.
Where's
It's
my
Christmas
Santa
time.
rally, Dave? I predicted a Santa rally. We're not going to get it.
Yeah, you're Mr. Negative Nancy tonight, and we're gonna get into that. But I feel like, guys, if you're listening right now, you might want to continue listening for this podcast because Brandon and I, like I said, the rules are we get together 5 to 10 minutes before the show and we tell each other what we're gonna talk about, and we were already arguing in that 5 to 10 minutes. So this is gonna be a fun one. We completely disagree. We're at two ends of the spectrum. Well, I don't know about two ends of the spectrum, but we're in disagreement here about some stuff. So if listening, you're going to hear us talk it out, and then maybe we'll convince each other or not, you know?
Yeah, maybe.
We'll see.
I'll convince you.
All right, well, first of all, let me start off then, because I want to go in where I want to go if you're good with that. You good with me starting off? Give me a thumbs up.
Yeah, go ahead.
All right. So I'm going to start off, guys. If you have a Fidelity app, or I use the Fidelity desktop when I'm doing like in-depth research, if you click on the news and research section of there, and then you could go on down and you could do news and insights, right? Or company news and research, scroll down, click on company news. It takes you to a page and it lists all the latest headlines for different companies in the United States. And this is interesting if you want to look into like maybe some insider sales, insider buys, different things going on. So one that popped out to me, so I watch penny stocks. I don't always trade them. Sometimes I do for fun. Sometimes I just do it to see if I can make a couple extra bucks on it. But one penny stock that caught my eye was Camber Energy, right? So this one was trading higher aftermarket because they have a reverse stock split coming. So they're going to reduce the amount of common stock available from 1 billion down to 20 million in a reverse stock split. Does this mean that the company is worth more or worth less? No, it just means that they're going to have fewer shares because it's not buying back. They're just taking it down the number to raise the stock price up so they could continue to be listed on the NASDAQ. That is typically what happens here. This is going to take place on December 30th of this year. Because of that, that is the only big news that this company had, and yet they are up 50% after hours. Brandon, is that a good reason to buy a company, a reverse stock split?
Not at all. The whole reason why you buy a company, not the whole reason, but the reason why you would look at a valuation of a company, it's the market cap. That's how you value a company. You know, when in the price to earnings ratio, price to sales, price to book, all of that stuff, return on equity. But none of that is affected whatsoever by the actual share price. Plenty of companies that you can buy, $30 or less, would be more expensive actually and more risky than other stocks that are, $500 or more a share. So
yeah, I completely agree. If you're one of the people who had bought Camber Energy today as it was going down throughout the market day, you made 50% aftermarket. Congratulations. I believe you got lucky. And I think I would take your money and take that profit and be happy, is what my advice would be. But yeah, I found that interesting. It's just something that caught my eye as I'm scrolling through the list. The next thing, it starts off a point where Brandon and I disagree, but it was something else that caught my eye. There's a gentleman out there, Edward Shapiro. He's a director with United Airlines, and he made an insider purchase of 25,000 shares for almost $1 million of United Airlines. The reason why I find this interesting is, as a sector, Brandon, a sector is how I'm going to preface this. The airline companies are the only one who, as a sector, has said that they're going to have. They gave good guidance for 2023. They have all said, hey, we're going to do better in 2023. We're going to do great in 2023. Delta even has cash on hand to cover any expenses that could happen. Of course, Delta is the best of the bunch, but I mean, they were all saying 2023 is going to be a great year.
Yeah, and I've always liked Delta under 40, but it's a cyclical industry. And I think we're heading into a recession next year. Like this time, it will be an actual, like, you cannot argue that it's not a recession.
Well, I mean, but is that going to really? All right, so it does affect air travel. It affects leisure travel. People still have to travel for business. Businesses are now asking their employees to come into the office. They, even the most stringent companies that really push for work from home are asking people to spend half the week in the office. So now you're having more people in the office, more people actually going out there visiting sites and traveling around the country. The business travel is where I think that they're talking about they're going to see the biggest jump. It's not necessarily the leisure travel.
Well, I mean, they're saying that they're better than they were in 2019 so far, numbers wise, and travel wise, especially domestic. And international will probably catch up next year, but
where are you getting that number from? Because what I'm hearing is that they're saying that they have not yet surpassed the height of pre-pandemic levels.
I just heard that on CNBC the other day that domestic travel had surpassed 2019. It could be wrong.
All right. Well, I see more upside for the airlines next year, and they're even with a recession, I see them having some good upside because a recession I believe is just going to give us a 5.5%, maybe at worst possible case scenario a 6% unemployment rate.
I hope so, but it seems like there might be some issues happening in the commercial real estate industry. But yeah, I don't think, I mean, it might not be like a 9%, unemployment like we got in 2007, 2008. But the worst that you're going to have is going to be a recession. The best that you're going to have is going to be a pullback in the economy and a pullback in GDP. But you can bet next year is going to be a tough year again. So, and then I think cyclicals are still going to have a tough time, and airlines are cyclical. Now I will say this, I still like the values of them. So, if you are on Dave's side, you have my blessing to go ahead and buy. Because if I'm wrong, then you'll be fine. And then probably in 2 or 3 years, you'll be fine anyways.
And I'm not saying go out there and buy, the Southwest or any of those. I'm talking about Delta United.
Yeah.
I'm talking about the best of the bunch here, the ones that are the most solid and have the cash on hand to cover any kind of downturn in the economy.
The ones that make money.
The profitable ones, yes, exactly. And during the pandemic, they used that opportunity to get rid of aging aircraft and need to cut their workforce down. So now they're rehiring, but not at a fast rate. They're being more selective with the hiring, which is I look at all those as good signs.
Yeah,
I mean, because you can look at workforce cuts as good signs, because look at Meta. Meta took a jump up today because everybody was happy with what the choices that Meta's using.
but then JP Morgan upgraded them.
Yeah.
So
yeah, that's because they're making changes and they're adjusting their business accordingly. But the airlines, I think you're going to see a positive year for the airlines next year. They are cyclical, but I mean, so you could make the same case for semiconductors. Semiconductors are cyclical, but at the same problem with them, they have a unique situation where during the pandemic, they ordered so much, and all finally came in, and then they were in an abundance of supplies, and then they're short in some areas, and then the China tariffs, they can't move this here and that there. There's so many different geopolitical and supply chain issues with the semiconductors that the industry is a mess right now, and that's why they're all down. Yeah. But next year, can you say that they're going to be up?
No,
they're not going to work through these problems by. I don't believe they'll work through these problems by next year, by the middle of next year. No.
So I want I want NVIDIA in my portfolio. I just don't want it yet. I think that you're going to have a better opportunity in the coming months for cyclicals, and high, things that are highly susceptible to the problems of a recession. What I'm going to be looking to buy in the next year is going to be stuff, that can still continue to make good profits and can still continue to grow despite problematic macroeconomic, atmospheres and environments. The thing is though, right now those stocks are they're still too expensive. I'm not rushing out to buy those either, because I think, we get a recession, I think they'll come down as well, but you're going to have a good, opportunity to buy stocks that come down when their earnings aren't getting hit as hard. Things like Coca-Cola, Procter and Gamble, Clorox. To me, they're too expensive right now, but I think that you'll get a good deal, and I'm going to be shooting to put those into my portfolio. Go ahead, Dave.
So here is where we disagree, man. Like, yeah, you're saying, yeah, I want to start, adding some good value companies that are going to have good growth, because that's what you buy in a downturn in the economy. Yeah. You buy when everybody else is selling and things are dropping down. You start purchasing. I go back to my analogy that I use over and over again. I have $1,000 I want to use to buy, say, ABC company. I start putting in $100 a week until I'm fully invested, and then it starts turning. Then I start selling. So we using that analogy. My timeline for starting to buy is further up than yours. You believe that, because I made the comment before we started recording that I'm looking to possibly be all in by February, and you look shocked at me. You said, "Whoa, that is way too soon. We're gonna go deeper with this than February."
But Dave, I'm data dependent.
Well, what data are you using for that? What data are you using to justify further out than February to start buying in?
I don't think this time, I don't think the market bottoms until the recession hits this time. I know, like in past recessions, market has bottomed prior to the economy itself bottoming, but I think we're at least going to have the news that we're in a recession. We're at least going to have the news that we've had 2 declining quarters of GDP before the market actually does bottom again. Now,
see, I see things differently, man. I see that the Fed's going to continue to raise rates because inflation's not under control. The inflation report came out and it was lower than what expected, right?
Still high.
It was at 7.1%. Yeah. That is extremely high. And the Fed acknowledges that, yes, it's starting to come down from 9 point some odd percent, which is nothing to be celebrated about. And it's coming down from that high, but it has a lot more way to go. And so they are drastically raising rates. I mean, look at the UK. The UK is drastically raising rates. And well, they raise it by a full 100 basis points because their inflation is still at 10%. Yeah, they're still at 10% inflation in the UK right now. People are losing money, and right here, we're celebrating 7.1. The market rushed up on that. No, you could put a put on anything after the market jumped on that news.
That was actually like the one thing that I got right with my Santa prediction when I said that we were already up against the increased interest rates of last year. The inflation rate was going to come in looking soft and the market would react positively to it. I also thought that Jerome Powell would come out and then seem a little bit more dovish, and that the market would be like, oh, he's pivoting, even though he's not pivoting, and he's never said he's pivoting. But, so I thought we'd get a Santa rally off of that. We got a small rally, and then that's all that happened. But no,
he has to remain hawkish. He has to. If he wants to tackle inflation, he has to.
Here's the problem, though. Like, high interest rates is a Band-Aid for inflation. What you really have to do is stop doing inflationary things. And the federal government seems intent on spending us into 1970s style inflation. You have like a tug of war going on between the Federal Reserve and the federal government. And until we stop, and I don't want to be political here, but until we stop wanting things for free, inflation's not going to come down.
All right. But I'll give Jerome Powell this, and I agree with you that he was late to the party. You even called it that he wouldn't do anything until after he was reconfirmed again. And that turned out to be 100% true. Unfortunately, he was playing politics with Americans. But now that once he was reconfirmed, he did start taking action. They are unwinding the QE, the quantitative easing. So that's a slow process that is happening. So those are the two things he has in his control, and that's what he's working on. I'll give him that.
The more we as a society and the more the federal government spends and spends and spends, the more Jerome Powell has to raise interest rates.
So let's bring it back. Yeah, so let's bring it back to investing, right? So when I say hawkish and Brandon says dovish, and we use these terms, if you don't know and you're a new investor, dovish means that a Federal Reserve chairman is coming out and he's making comments that the market wants to hear. When we say hawkish, he's making comments and doing things that the market doesn't necessarily want to hear at that time. So what that has to do with investing is if the Federal Reserve is going to remain hawkish position, and they're going to continue to tighten and raise rates, that means that it's going to push the market into the economy, possibly into a recession, what we're talking about. So in my opinion, this is where Brandon and I differ. I believe that that's when you start to buy, and that's when you start to put your money in and you get 100% invested so that when it bounces back up, you can sell and make a ton of money.
I agree with you on that. I just don't think it's going to happen in January. I think it'll be a little further out. I could be wrong, but let me preface this. Let me say this real quick. Whether it's January or not, if you're buying based on the numbers and based on the value of the stock, it doesn't matter. So if you have Google or Meta or Procter & Gamble or Coke come down to good valuation levels, buy it anyways. Don't say, oh, Brandon doesn't think it's going to bottom in January. He's looking more towards middle of the year. I shouldn't buy now. Because if I'm wrong, you're going to miss your opportunity. Why did I buy Google like a month and a half ago? Because if my macroeconomic forecasts are wrong, then I'm going to miss out. And then it's not FOMO that I'm worried about, because this is a rational thought. Even if I'm right in the middle of next year, 3 or 4 years ago, or 3 or 4 years from now, I'll be fine. Right?
Oh, yeah. If you're buying value companies 3-4 years from now, you're going to be doing just fine.
Exactly. And if your investment thesis is that, years from now, you'll be all right and you'll be happy that you bought today, then who really cares what happens over the next 6 months to a year? And, even better, if you were wrong and if I'm wrong, then we'll be better off anyways.
Because retail investors and the people who listen to us, not people who listen to us, hopefully, but retail investors as a whole generally like to make money quicker than 3 to 4 years. And that's a problem, and that's not a good thing, but that is the case. And that's why they don't want to wait and hold and have those diamond hands. They want to hurry up and make trades.
That thought process is literally handing over every advantage that they have over everybody else in the market. The market managers have to watch the stock markets every day, because what they're doing, their clients are uneducated in the market, and their clients are saying, why am I down 10% in 2022? What's the deal? I'm going to fire you now, right?
Yeah.
But you don't have that problem as an individual investor. You don't have to care if you're down 5-6% this year, or if you're in line with the S&P and down like 18%. You don't have to care about that. If you've got a 20-year time horizon, your advantage is that you could take advantage over other people who are overacting. And if you're overacting, you're giving that advantage up.
I like the way you put that there. That was good.
They're doing too much, some people,
Yeah, you're right. And I don't know, man. I still think that we're going to see the downturn hit in January. You're going to see a sell-off because you look at the retail numbers. There's your data. There's your microeconomic news. Retail terrible. Numbers came in lower. Yeah, it was horrible. And they didn't adjust those numbers for inflation. And not only was it negative, not only was it down year over year, but they didn't include the fact that inflation was up so much, and so it's actually even worse than what it said.
and it was down month over month. November's numbers were worse than October's.
Yeah. I mean, this is it's a bad sign for the economy. It's not a good sign for the retailers. Everybody was applauding the Cyber Monday deals, but it seems like that's when everybody saved up all their money for those Cyber Monday deals, and even that was not adjusted for inflation. When you add in a 8 or 7, let's say 7, let's give everybody benefit of that and be conservative. When you add in a 7% inflation rate, I mean, that takes away from any positive you can find in the retail market right now.
And now all of these retailers, especially in apparel, that over ordered on clothes when transportation costs were through the roof and when raw material costs were through the roof, and they paid all this money, and look at Carvana, even in the auto industry, they paid all this money when rental cars, and not rental cars but used cars, were so high. They bought all these used cars, and now they're gonna have to unload them at lower prices, and retail's facing the same thing. All these retail companies with overstocked back rooms and overstocked sales floors that can't get rid of anything, and they're having to discount it. That's a big
Yep.
problem. You're having to discount stuff that you bought at an inflated price.
Yep.
So
It
I
is a
think
big
we're
problem.
probably going to see some bankruptcies.
And
And
yeah, but I'm saying you're going to see it. You're going to start seeing it in January. The market's going to start moving down. The Fed's in February is going to announce a continued rate hike of another 50 basis points. It's going to cause everything to drop, and you start buying in February.
I think you have to watch, though. When talking about the airlines, you have to watch cancellations. That's what I would look at. They've got a lot of people who've booked their flights, and a lot of these people bought the insurance that can cancel it before they even get to before they get to the gate. So just watch the cancellations, because I
But
don't know that their forecasts are going to be exactly right.
all right, so
But
but who's going to do the cancellations? It's the people that are right on the edge, right? They're living paycheck to paycheck. And when a recession hits, they're the ones who are going to break first. So they're the ones who are going to do the cancellations. Do the people who live paycheck to paycheck fly Delta? Or do
no,
they fly Spirit? Do they
no,
fly Southwest? Do they fly all these other low cost airlines? They don't fly Delta or United, man.
right. That's true. That's
That's
true.
why I'm saying Delta United are good companies to own going into 2023. Now, I would wait because I think the market's going to have a couple more bad news over the next couple of weeks. Wait for some more downturns, wait for more dips, and then start creating a position, man.
Yeah, yeah. But you just wait for the companies to become valuable. Um, I do like Delta, though. I have to say I do like Delta for years on out. Anything under 40 for Delta is good. So
Right there, you go. All right, I do want to. I'm going to hand it over to you right now and let you talk about a few things, but I will try on the Instagram guys to show you some screenshots of where to get this, if you will, company news page on Fidelity. That way you guys can all access it as well. You can open a Fidelity account for free and you can access this. It's great for research. It's great for just catching headlines and seeing if you can catch a good day trade or not. Be careful when you're day trading, though. Make sure that you have a company that's moving of enough volume that you could get in and out. You don't want a small company, if you're going for penny stocks, that is only moving 10,000 shares a day, because you may be stuck in it. Make sure you look for companies that have volume moving. But Brandon, go ahead. What do you have?
yeah, I've been buying tech because tech is already beaten down, and I know that it's cyclical and all of that. But there's a few good companies out there that I think have come into good value, like Google. I like Microsoft as well. The management is just phenomenal. You're paying a little bit more of a premium for Microsoft than you are some of the other tech companies, but you're doing it for a good reason. What I'm really looking for in the next couple of months is I'm hoping to get a shot at some consumer staples and some non-cyclical companies. I bought Coke a year and a half ago, and then I sold it, and I wish I would have never sold it. It's one of the only stocks in the market that's up this year. So I'm a little embarrassed to say that I sold Coca-Cola and didn't just pull a Warren Buffett and hold it for the rest of my life. But I also like Pepsi too. Pepsi's been phenomenal. Management there has been great too. But these companies right now, they're just too expensive. I don't want to buy Clorox with a 30, a PE of over 30. That doesn't make any sense to me.
Hold up, I'm gonna interrupt you here because first of all, you're using PE as the only value. PE ratio is a good ratio to use as a tool, but
It is.
it should not be your only reason to buy,
I,
because something could have a high PE and a company could have a very high PE, but they actually continue to grow into that PE at the rate that they should. So then it's still a value at its current price.
no, I don't think Clorox is going to do that. I understand what you're saying about PE, but price to sales is still high on Clorox as well. So it's price to book, and it's just not, the growth isn't there to justify it. They're gonna, like, it's nice steady growth, don't get me wrong, but it's nowhere near 30. And so no. The other thing that you have to watch out for when it comes to price to earnings ratios, when earnings start to decline across the entire country, and things start to take a hit, price to earnings, they go up because earnings come down, right? So you're right. Like, these valuation tools are just that, they're tools. They're not substitute for thoughts, and they're not the only reason. They're tools to help you think and to help you draw conclusions. They are not the conclusion by any means.
So yeah, and I want to, if anybody's listening and you're new, I want to cover two things real quick. Brandon, I'm going to ask you to define cyclical here in a second. I'm going to cover PE ratio because you're the smart one and I'm not the smart one. So PE ratio, guys, price to earnings. So a company has a stock price of $10 a share, and they come out with earnings of $1 a share. That PE ratio is 10. That is how you work out those ratios. Or did I get it wrong?
No, you got it right. I'm
Okay.
sorry. It's my
Brandon was holding up signs if you're listening right now to me. I didn't understand, but the PE ratio would be 10. So that's how you figure it out. So you want a lower ratio because that means the cost of that per share is almost in line with how much the company earns per share. And that's typically a sign of a stronger company and something you want to buy.
Yeah.
But I mean, that's why I was going to my point. Like, if a company comes out and they're a new company, typically a new startup just came out, IPO'd like with a couple of years ago, they're still growing at a fast rate. They could have a high PE ratio, but that could be justified because they're growing at such a high rate. And that's what I was talking about as far as PE ratios. And Brandon also agreed that it's a good tool to use, but use it as a set of tools with other things in
Yeah.
conjunction.
Yeah. And the other thing about price to earnings ratios, and other ratios that take earnings into effect. Some companies' earnings are actually worth more than others. First of all, because some companies tend to grow their earnings faster. Second of all, because other companies often, or sometimes at least, owe more of their earnings back in debt replacements or debt repayments and obligations. So a company that has zero debt and is growing earnings, their earnings are going to be worth more to the investor than a company that has higher debt and slower growing earnings or whatever. So earnings, like, you really have to do your own research, and the ratios and stuff like that are great tools and great, they're thermometers, right? You go to a doctor, you have a temperature. It's a symptom of being sick, but they're not going to diagnose you because you have a 102-degree fever. They're going to diagnose you because of a couple of different things. Same thing with stocks. They're thermometers to take the temperature gauge of a stock.
But what about
Oh,
cyclical? Because we've used that a couple of
yeah.
times. How would you define cyclical?
Cyclical. Okay, so cyclical is, this is a kind of a company that is more sensitive to market cycles. So more seasonal kind of stocks, like, but semiconductors are more seasonal in nature, but they're cyclical as well. Cyclical stocks have more sensitivity to macroeconomic conditions than non-cyclicals, which non-cyclicals would be like, stuff like you have to buy no matter what. Like, you're going to starve to death if you don't buy food, right? So even during a recession, you need food. You might switch what kind of food you buy, but you still need food. You still need water. Even some people consider alcohol non-cyclical, and it seems to do better during recessions because it helps people feel better about their situations, at least in the short term. Yeah, so I mean, I'm looking at, like the Coca-Colas, the PepsiCos, the Hormels for the chili, those kind of stocks right now. Um, I really want to get a good shot at those, and I'm hoping I do.
There you
I have
go.
enough of them. Like my portfolio is way overweight cyclical, which is kind of scary right now, but it's all right.
Nice. All right. So yeah, so we define these, and we use these as tools, and we try to just help us decide what we're looking at buying. I will spend next couple minutes talking about a stock that I've had trouble with the last few weeks, and it's been a thorn in my side, and it is Tesla. Tesla. Here I go in my 5 minutes every week on Tesla. Um, so this week it is down again, and it's down again a lot. So next time it goes back up and I'm near breaking even, Brandon, I just need to sell because I've been near breaking even multiple times now. But Tesla, with the deal with PepsiCo recently, and that they're going to start using Tesla tractor trailers. They have 200 of them that are going to go into effect in the next year. And they're going to be on the roads moving around. Tesla continues to drive that part of the company, which is electronic trucking and then autonomous vehicle trucking and autonomous vehicle taxis. Tesla continues to grow in that aspect and is making a lot of money. Now, Tesla has been down partially due to Elon Musk selling and Elon Musk Twitter issues, and that's been taking the headlines. On CNBC today on Fast Money, the team on Fast Money was sitting there and they all dogged Tesla. And they said, if Elon Musk is selling, that tells you right there what is going on. And I disagree. And here's why I disagree. Here's my 2 cents on why I disagree with that. Elon Musk is selling his shares because he's using that money for other purposes and other companies. Tesla is growing strong. They continue to sign new deals. They continue to grow in all aspects of the company, even the solar panels, the batteries, the electronic vehicle trucking, the autonomous vehicles all continue to grow. They're even building robots to be able to work in warehouses and take the job of people. If you were looking at Tesla as a pharmaceutical company, you would say that Tesla has a very strong pipeline of drugs. Tesla has a very strong pipeline of products. I disagree with the panel because of how I believe Elon Musk is using the money he is withdrawn from Tesla, and he's putting it in other businesses and other areas of his life. He's not taking it out because he doesn't believe in the company. Tesla is great for the long term. I do believe you have to be long-term Tesla right now to buy in. I was wrong about my day trade. I continue to lower dollar cost average down. Not too much anymore. I'm not putting as much as I want to because I'm waiting for other companies to drop more so I can create positions in other companies. However, I am confident Tesla in the long term will be a good company to own. Brandon, any thoughts on my latest Tesla outbursts?
It's a diamond in the rough. It's one of the only stocks I can look at and say that it justifies the current multiple that it has, which is the price to earnings, which is 44. And I know I keep referencing that, but Dave, I would think normally when I saw a stock that has still the valuation that Tesla has, normally I would say you took every drug in that pharmaceutical company pipeline, but this one I think it justifies it. I see nothing but good growth, and I think the automotive industry is going to be. I think it's going to surprise everybody this year. I think used cars is going to be awful with Carvana. But I still think Ford and GM and Tesla are good buys, and I would be Tesla. Tesla or GM would be the two that I would pick in automotive for the coming years.
I think the automotive lenders are where the trouble is going to be in the market because of, again, we've talked about on the show, the subprime market is on a teeter, and it's just people living paycheck to paycheck are underwater on their cars. The 270,000 people who bought homes this year that are underwater on their mortgages. There's all kinds of people that are underwater on loans, and I believe those auto lenders, such as Carvana, which is a part of Bridgecrest Linden, sister companies, but the same company, that's where the trouble is the subprime Linden and people defaulting on their loans, and we're going to see more of it. And that's what's going to cause us all to tilt. I've talked about it, and I said that, the Apple credit card will probably be one of the first things to go, but I don't know anymore if it's going to be Apple, or I think Carvana was the first one to start tilting because they are their own financial company, and that's where the problem was. It was the subprime. And, when you lend out subprime at such large numbers,
And
you're taking a big risk.
Apple did it. I still think though, for me, like people still consider Apple cyclical. I don't think it is.
No. Apple has too tight constraint on its consumers. If you have an iPhone, then you have a Mac, and you're all in that ecosystem, and Apple just has you tight and controlled, and they have you under their thumb, and you're not ever going to leave it, and you can't leave it. And that's why Apple could turn around to every single person who makes an app, every company makes an app and says, no, we're going to charge you 30%. On all the money you make off of your app if you want to put it on the Apple store. And I think every single company that makes apps just needs to leave Apple. And I think that would I think if you did that, people wouldn't find a use for iPhones anymore, and they would stop using Apple and they would switch to other phones because they can't get the apps they want, and therefore Apple would have to switch and change
it's too risky. And a lot of those companies would be leaving Apple for the wrong reasons. They'd be leaving partially because of the Apple payment thing. And what you're referencing is the new iOS rules, which they now state that if you're a company that like social media that makes your users pay for their posts and for their profiles to reach more people, that you now have to use the Apple payment system to do it. And Apple gets 30% of the cut. But I think that a lot of people will see too, if like Twitter and Facebook and TikTok leave Apple, part of the reason that they're doing it is because they want to track you, and Apple doesn't want them to track you.
Because Apple does it, and Apple wants to control the tracking.
I mean, the privacy settings on iOS and the Apple Store, that's what's causing the backlash for the most part. And that's what's costing Google and Microsoft, well, not Microsoft, but Google and Apple and all of them, all that money.
You can have the same privacy settings on a Samsung. You do, or if not better. You just have to set it. It is. You can look it up. Look it up, man. It's the same. But I mean, I think there's some issues there, but no, Apple's not cyclical because they have you in the ecosystem and you can't get out.
Yeah.
So that's why they're always going to continue to make profit, and they have billions. And what they have, what was it, 100 billion in cash right now?
I think it was like 95 or 96.
I mean, round up to 100. Okay, they could buy a few companies if they have to, with cash.
That's what I love about them, though, is that they don't do that, though.
It's crazy. They're a monster company, a monster behemoth company that people just don't challenge enough. I think we need to challenge them some more and ask more of them than what they do. So that's just my thoughts on Apple. As you can tell, I have a Samsung, not an Apple, and Brandon has an Apple, not a Samsung. So we are disagreeing on that. Brandon, let's wrap it up about stocks and investing, huh? Let's do that. Okay. Stocks and investing.
What are we going to talk
Final
about?
Thoughts.
Wrestling?
No, final thoughts, man. Stocks and investing. Final thoughts.
Yeah, just that I'm not doing anything right now. I do think that there's some good values, but the good values I already own. So, and they're the non-cyclical stocks that have gotten so beat up right now. But I think that you're probably like, there's no reason to rush out and buy them right now. Even the ones that I own, like the Googles and the Amazons, Microsoft, stuff like that. There's no reason to rush out and buy it. I think you might even get a better deal than I did in the coming months. So I'm sitting around right now on my money, waiting for the Cokes and waiting for the Pepsis and hoping I get a good deal on those.
I am also waiting on my cash. I've lowered how much I'm willing to spend on DCA in my Tesla position. I might just hold what I got and not put any more money in. But I'm waiting on the rest of my cash for the market to come down some more. I believe it's going to come down sooner than Brandon does. That's where we disagree. However, we both have the same plan, which is wait for the market to come down and then buy in.
Yeah, you think it'll bottom before I think it'll bottom. So I think it's still going to be coming down. It's just a question of when it's going to bottom and where it'll bottom out.
And that's where we disagree. And I believe 2023, the airlines will be flying friendly skies, and we will see that happen. That's just what I see. I like the guidance given by all the airlines. I think they're good buys, but wait for a downturn first before you buy in. You're probably going to see a big sell-off this year at the end of the year, considering all the financial firms are going to be laying off 5 to 10% of their workforce. You'll see a lot of people selling stocks at the end of the last week of the year for tax reasons. So be
Didn't
wary.
that already happen though? Didn't
No, it happens every year in the last
Yeah.
week, but I think it's going to be even more this year. I think it's going to be even more this year. So look for that, guys. I think use that as a good opportunity to get in on some of these companies during that time. But that's my final thought. As always, guys, we hope we've been entertaining, educational, and uplifting because we want everyone to make money. Have a good night.
Have a good night.